Hello, happy Thursday. Welcome back from a 4th of July weekend. We have a good amount to cover here this week. We've got the Fed minutes released, so kind of the first glimpse at what may come up here in the next Fed meeting. And we're kind of kicking off jobs week, although a little bit of a twist here this month and probably the next as well. My name is Brandon Steele. I'm a financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. This is our first session back after the 4th of July holiday weekend, so I hope you had a great time celebrating. And if you're in the Pacific Northwest, hopefully you were able to stay dry until the sun came out on Monday afternoon. Anyways, obviously with the 4th of July on Monday, the markets were closed, so we have a bit of a shorter week this week. But kind of hopping right back into things, on Wednesday, we had the Fed minutes released, which can be the first kind of glimpse at what we might expect coming up in July. Of course, they hint at some things in the previous meeting to kind of give us an idea of what to expect. But this is the minutes for the meetings to come, basically. So basically what they had suggested is probably somewhere between 50 and 75 basis point hike in July, which is again 0.5 to 0.75%, which I don't think is much of a surprise, from what they've been sharing. I know before, I didn't believe they were going to fully commit to this and really rip off the Band-Aid. I think they needed to, but they had not. And actually they did last month and increase rates by 0.75 or 75 bips. So possibly, very likely, we may see that again, especially since we'll get some inflation data coming out next week. A little bit of a hint at what's to come, but some inflation data coming out next week. And depending on some of this, we may see that 75 basis point hike again in July. This is the start to jobs week, but again, as I mentioned, it's a little bit different this month and also for August. And the reason for that is that generally on Wednesday before the non-farm payrolls, we get an ADP employment report. This is actually being paused until I think it's late August because they're kind of revamping their reporting, which if you follow kind of what we talk about here week to week, probably is a good thing, because generally we don't put a lot of weight on the ADP employment report. It's really the non-farm payrolls that come out on Friday that we pay a bit more attention to. So nothing to report there yet, but again, maybe a good thing when this starts again. I guess it'll be, I think it's like August 31st, and then they'll get back into their normal cadence, I believe, from there. We will certainly be coming back to that, but for this early July report and then coming up in early August, we may not see an ADP employment report come out. We did have job openings numbers come out at 11.3 million, up from an already huge number, right? This is I think it was 11.1 million last month. So, it's obviously going the wrong way, and it's a giant number to begin with. We also had initial jobless claims come out today on Thursday at 235,000, which is, believe it or not, a 6-month high. Now, that said, it's not a whole lot larger than it was last week, excuse me. So kind of, take that with a grain of salt, but it is a 6-month high, and it's important to kind of note, for the most part, with everything that we've seen in the economy, when you look at the potential for a recession or what kind of we're dealing with and the challenges today, we haven't really seen those come through in terms of the labor market, in terms of earnings and all that good stuff. So we want to really pay close attention to the jobs market, because as interest rates rise, as inflation gets carried through to companies, that might be where we start to see some cracks. So I'm not saying that this is a sign that the cracks are expanding, but it's something to really pay close attention to in the coming weeks and months for sure. Coming up next week, of course, we'll break down the non-farm payrolls number that comes out tomorrow on Friday. But we also have unemployment and CPI numbers coming out next week. So we will be breaking down jobs, inflation, and everything in between. For this week's question of the week, we have a really good one, which is basically, will the Fed backtrack? Will they need to backtrack on all this rate hiking that they're doing? I think it was Michael Burry that came out and kind of started a lot of this conversation from a big media perspective, anyways, because obviously he's a big name. The one of the main people in that movie, The Big Short, and somebody who had kind of seen the housing crisis in 2008. So this is a big media opportunity, I think, that's kind of come up recently, and something to really pay attention to, because obviously the Fed is starting to become a little bit more aggressive in their rate hikes, right? They've talked about an extra 2% basically through the end of the year, which means some very aggressive. It basically means 50 basis points on average, but a couple higher hikes in between as well. So very likely that they're going to be aggressive here moving forward through the end of the year to try and tame inflation. And the question really is, okay, with all that, that's all well and good, but what is the impact to the economy? And is the Fed at some point going to need to backpedal a little bit and actually drop rates back down again? Obviously, it is very difficult to say that that is or is not going to be the case at this point until we kind of figure out a little bit more how this stuff works its way through the system, right? Just like going back to COVID, and when we turned the economy back on, it doesn't, like, we still are dealing with supply chain issues from that. So when we raise rates, it's not like we feel the impacts instantly. There's a bit of a delayed fuse in terms of how that carries through to the economy. So it's very hard to answer that directly, but I do believe that part of why they're hiking rates now is to give them the tools that they need if they need to pull rates back down. So it's a little bit of a workaround answer to the question directly, but I guess the more direct answer is I think that that's very likely, and I think that's why they're becoming more aggressive with their hiking today, is so that if the impacts of this are felt, they have tools in their back pocket to try and stimulate growth again. If interest rates were at zero and we went through a big recession, unfortunately, the Fed couldn't really do a whole lot, right? Number one, they were already buying assets. Number two, the interest rates were at or near zero. So what could they really do except negative interest rates, which is a whole separate story. But what could they really do to help spark some growth? The answer is not a whole lot. And so by raising rates now and being aggressive, I think what they're giving themselves is a little bit of room so that if we see that, they can reduce rates and try and spark some growth again if need be. So very good question, very timely. Of course, if you guys have any questions for us that are on your mind, drop it in the comments or just reach out to me directly. And if we do use your question, we'll send you a coffee on us for the great thought. So have a great upcoming weekend. I hope you had a great 4th of July. And we will see you next Thursday at 3 p.m. to really break down jobs and inflation numbers. All right, have a great day.